Second voiceover in Chapter 9 is on depreciation methods, and now we're coming up with a number. We know that it's a debit to depreciation expense and a credit to accumulated depreciation every time we do our financial statements. We said this was an adjusting journal entry that needs to be done. The debit is to an expense which shows up in our income statement, and the credit is to accumulated depreciation, which is a contra asset, and this contra asset is going into the balance sheet. Straight line depreciation is a calculation that's very easy to do, and it's based on the number of months or the number of years usage, how long you expect to use it, and it'll be the same amount for every time period. Units of production is when you take an amount that's based on how many units are produced. Now, it also could be applied to the situation where you have automobile tires. You could think of it as, well, these automobile tires should last for 30,000 miles. Therefore, if this year I drive it 10,000 miles, then 10,000 over 30,000, or 1/3 of the total cost of these tires, should be in depreciation expense for this time period. Declining balance is a little tricky because this method does not take the same amount each time, nor does it relate to how much the asset is used. Instead, it relates to the book value of the asset, and the depreciation is such that the amount of depreciation expense declines each year with this method. The one that you're going to have the most difficulty with is going to be the declining balance method. It is by far the hardest to learn. If you find it challenging, this is fairly typical. Straight line, though, is very easy. In straight line, the depreciable cost is the cost of the asset. This includes everything to get it into a usable location and condition. And it may also include other capitalized costs that we talked about in the last voiceover, minus residual value, which is also the salvage value, what you expect to get out of the thing at the very end. This depreciable cost then is spread over the useful life. So useful life, how many years, how many months, and that would be the rate of depreciation that you're going to take in each given time period. So if this were an asset that cost $62,500 and we expected to be able to sell it for $2,500 at the end, then $60,000 would be the amount which we need to remove from our books in depreciation expense over 3 years, or we would take $20,000 per year to depreciation expense. We oftentimes will create these schedules, and these schedules are helpful when you get to double declining balance, when you get to units of production. For straight line, it really is a bit redundant. You probably wouldn't have to do this to determine what your depreciation expense is going to be, because as you can see from the schedule, it's $20,000 each year. One of the assumptions within this schedule is that we are going to have used the asset for 12 months of the first year, 12 months of the second year, and 12 months of the third year. This is often not the case. This assumption here is that if your fiscal year ended December 31st, that you would have bought it January 1st. This is not too logical. A company doesn't go out and buy all their assets the first day of the fiscal period. They buy the assets as they need them throughout the year. So the first year's depreciation would technically be allocated based on the number of months in which the asset was used. So if you acquired this asset in the middle of the first year, then you would only have $10,000 in depreciation expense because you would have only had the asset for half a year. And also what you would have done then is when you did it for 3 years of depreciation, In year 4, you would have 10,000 in depreciation. So your total depreciation in this sense would have still been 60,000. It's just that you need to take into account at what point during the year in which you buy it. A little technical difficulty. Okay, so it's not realistic to assume that your first year would be 20,000. It's only going to be 20,000 if you used it for the entire year, or you owned it the entire year that first year. Alright, so accumulated depreciation is going to go up by 20,000 each year because it accumulates. Depreciation expense does not accumulate. It's recorded on the income statement. So each income statement time they have 20,000, a total of 60,000. If they put this into accumulated depreciation, then the book value, if they were to do a financial statement, would be 2,500. And the book value for the last time in which depreciation is taken should be equal to residual value. That's the methodology which we're taking. We want to have an ending book value so that when we get rid of the asset, we are going to remove the book value of the asset. This is coming up in a later voiceover, but for now, our job is to depreciate an equal amount each time period under straight line and to have the residual value as book value at the end of the accounting period. Now, in addition to taking this method, which is straight line, and we're going to divide again the 62,500 minus the residual or salvage and divided by 3, we could have also based it on the miles driven. And that's the second one here, units of production. I don't quite understand why within this they're talking about a ride, which is a carnival type ride, and they're talking about miles. I would tend to think of this probably being done as hours operated, or maybe units of electricity used by the machine or something. That seems more logical. But here they're basing it upon the miles, and so again, 30,000 divided by 100,000 would be 3/10 for your depreciation rate here. This is going to be cost minus residual. Again, it was 62,500 minus 2,500, or 60,000 we want to spread. So we want to spread 60,000, and we're going to spread it over 100,000 mile usage. So an alternative way to making this calculation would be to say, okay, what is the amount of depreciation expense per mile? And then multiplied by the 30,000. Either way you do it, you're going to come up with $18,000 for your depreciation expense for this time period. This method again would be good if you're talking about automobile tires. It would be good if you're talking about equipment in a manufacturing plant. You could also look at it as in units produced from that plant, and hence the name units of production. If you are a bottling plant, a Coca-Cola, a Pepsi bottler, and you are putting bottle caps on glass bottles, your machine was doing this, you could count up and find how many bottles were produced in the year, and you could use that for your basis for depreciation. If you knew for how many bottles, caps were put on bottles, or your estimate for this particular machine, you could use that method. In this case, we have year 1, 30,000 miles, year 2, 50,000 miles, year 3, 20,000 miles. One thing you have to be careful of in this method is that if you were to use this machine and this machine were to be used for more than 100,000 miles, you would not take depreciation on any of those miles over the 100,000. In this case, we reached 100,000 in year 3. 30,000 and 50,000 is 80,000, and 20,000 is 100,000. So in year 3, we reach 100,000. And so when we take depreciation expense, we do 2/10 of the total amount in this year, or 12,000. It adds up to 60,000, which is wonderful, because now, after having taken this, fully depreciated this asset, we still have our residual, which is 2,500 left on the books. For this method, it's quite helpful to have this format or the schedule prepared, because you can look at it and you can see that our depreciation expense did not go over the 60,000. It didn't go over 60,000 because our cumulative miles of usage did not go over 100,000. And we can also see here that when we calculate our depreciation expense, it goes up and then it goes back down again. It's totally related to the usage over here of that machine. Now, declining balance, one of the most important parts, and I have it in red, is to understand that it is not cost minus residual. All students try to do that. They say cost minus residual. No, it's cost minus accumulated depreciation. And unlike residual, which is one number that stays the same all over the depreciation period, accumulated depreciation changes. It changes every year because new depreciation expense gets added to it. So this book value at beginning of period is going to change every reporting period. So you're going to have to recalculate that. Oftentimes we say with the double declining balance that it's twice the straight line rate. If you recall, a straight line rate is 1 over useful life, and this is 2 over useful life, so it's twice the straight line rate. This is multiplied to get depreciation expense. There's also a little trick in the final year that we have to remember. So by far, this is the most difficult of the 3 methods you need to learn. For the first 2 years, then, this again is not residual. It is actually the accumulated depreciation on the asset. Since no depreciation has been taken, it's 0 in the first year. So 62,500 times 2, and it's 3 for the 3 years, so 2/3 of that is 41,667. And I want to talk a little bit about this number. When you work in Connect and you get to these problems, you will notice in Connect that when you make the calculation, you may not come up with a number that is precisely the same as one of your options in Connect. Now, the reason for that is because of rounding. This number is technically not 41,667. I believe it is probably 41,666 and 67, and if we rounded it, it'd be 68 cents. So you see, it has to do with at which point you round the numbers, right? And when you come up with this particular method, the double declining balance, because the residual is not removed when you do this first calculation, the book value, oftentimes this number will not be a precise number. It is not precise dollars. So the rounding issue you may find in Connect. The second year, you're going to put in here the accumulated depreciation. For the second year, accumulated depreciation is the same as depreciation expense, right? This number is coming from here. But when we go to the third year, our accumulated depreciation will be the total amount of depreciation expense taken to date. Okay? So accumulated depreciation for the second year is going to be depreciation expense for the first year only, because there's only 1 year of depreciation expense taken. In the third year, you will have depreciation expense for the first year and depreciation for the second year in there. The 2/3 does not change. It stays 2/3. So this factor will stay the same throughout this method. As we said previously, And because accumulated depreciation changes, this second number in the formula will change. Notice also that depreciation expense in the first year is nearly $42,000, whereas in the second year it's only around $14,000. So it declines. So depreciation declines with this method. Depreciation expense declines. Then, residual value is not in the calculation. On the third year, then, our standard way of doing it would be to take the accumulated depreciation, which is up to date after the end of the second year, is 41,667 plus 13,889, or 55,556. This times 2/3 gets us 4,629. Again, there's rounding issues, so when you actually calculate it and you have it in your calculator, your number may be different from this by a little bit. When we put this in here, though, we have a problem, because if we take this number, add it to this number, and add it to this number, and come up with an accumulated depreciation number, our accumulated depreciation using this method after the third year would be 60,185. With that number and our cost of 62,500, our book value would not be 2,500. It would be less than what we expect as residual. Now we need to end up with this process no matter what method we use. We want to have the residual value or equal to the book value, and that to be 2,500. So what you see happening here is they're going back in what I'm calling fudging the numbers. So in the last accounting period, they're going to have to change this 4629 to 4444. And with 4444, it is 60,000. And if 60,000 is the total depreciation taken, it's the total amount in accumulated depreciation. And these two will net to the 2,500. So with double declining, you're going to have to go in, and the last time period may be required to make an adjustment so that you end up with the proper book value. Book value should be residual. With units of production, we also had a problem that could develop. With units of production, our issue was when we went over their estimated usage, then we would have a problem because we would take too much depreciation. So you needed to stop. In our example, it was at 100,000. You would stop when your combined usage was at 100,000, not take any more depreciation expense after that point. When you compare these methods, then, very important, double declining balance is not cost minus residual, it's cost minus accumulated depreciation, which changes in every accounting period. Double declining balance is the rate which is used is 2 times the straight line rate. In units of production, it's cost minus residual, but do take care that you do not go over a cumulative production amount equal to your estimated total production. When we look at the actual dollar amounts that we calculated on the previous slides, you notice that 20,000 is for each year, and this forms a straight line, hence the name straight line. On units of production method, which is the green one, it goes up, it goes down. It's very much related to our operating activities. Now, there are advantages to straight line, and one of those advantages is that if you're budgeting for your company, you know or can estimate, as long as you're keeping the same assets every year, you can estimate how much it's going to be. It's the same amount. If you use units of production, you have to think about how much you're going to use the plant, how much your production going to be, or maybe it's how many miles you expect to drive your delivery vehicles if you're talking about tire depreciation. But units of production tends to go up and down with revenue. So you have the matching principle used. When you have more revenue coming in, you have more depreciation expense. And the other thing about units of production that tends to make sense is it relates back to the actual value of the asset. So driving a car, for example, those tires, when they get close to 30,000, yes, they should be have a high accumulated depreciation or a low book value. Double declining balance is one that declines. So depreciation is high in the first year, less in the later years. And if you want to match this up so that your balance sheet reflects value, which again is not really our goal here, it's just to use some method to remove this asset from our books. But if you want a balance sheet that reflects resale value, then sometimes double declining balance is a good way to take your depreciation, a good depreciation method. An example being again an automobile. The value of an automobile declines very rapidly in the first years of usage and less in later years. And so yes, it matches up to a valuation of the automobile.